Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Julian Emanuel of Evercore looking for deals. Our base case is that the lows of this sell-off have been seen and that a recession will be narrowly averted. But the clock is ticking. The art of the deal needs to begin bearing fruit. Julian, good morning.
Good morning.
How exhausting is all of this?
You said 24 hours. It's felt like 24 weeks, basically. Look, we knew this was going to be this way, okay? I think if you go back to January 20th and you saw everything that was done on Inauguration Day, to expect this is par for the course, really. But again, it is the narrative of several weeks ago. There were still questions as to whether the Trump administration was willing to tolerate a recession to achieve some of its aims. What we've seen in the last 24 hours and going back to the pivot in early April is that is absolutely not the case. And removing the large left tail outcome in markets has been very positive.
Rewiring the system is difficult. We've talked about it a few times on this program, that you've got both a shock to the cycle and a potential shock to the system. But what we've also seen and witnessed down in Washington, D.C. is that some of these policies are so extreme, so out there, that they're somewhat self-limiting, that they're almost negotiating with themselves on certain issues. Do you get the same sense when you look at what's happening down in Washington?
There is an element to that, and again, it is the shock to the system. This concept that the all-in raw number to global weighted tariffs is higher than Smoot-Hawley. You don't really need to say much more than that, and that is the element of self-limiting. But again, it goes back to the negotiating style. Throw out the maximalist case out there and then see and wait for the other side to start responding.
And we saw that in Trump's first administration. This is a phrase I don't think the president likes, this idea of a Trump put. But have we now seen that there is a Trump put and there is a level that they are unwilling to deal with?
Well, I wouldn't necessarily call it a put per se, but again, it just goes back to this idea that there's an acknowledgement that the extremity of what they're trying to do and the speed with which they're trying to do it. And remember, all of this is set against a debt ceiling negotiation that has to happen in the next 2 months, and then further on down the line, the acknowledgement that the traditional historical tendency is for the Republicans will lose the House of Representatives in 2026. So you have to front load all of this. So that is the shock to the system. But again, there is no wish for a recession. And so, by that virtue, the Trump put itself does seem to exist south of 5,000 on the index.
John brought up a great point on whether or not they're negotiating with themselves. Maybe the president is going through the motions out loud, but also behind the scenes, there are 2 or 3 different rivals. This is a cast of characters in terms of the cabinet. At this moment, it does look like Scott Bessent, the Treasury Secretary, is leading the charge on a lot of this. Is this rally, is this relief just temporary if Peter Navarro comes back into being one of those driving forces?
Well, if you look at the cast of characters, there are some who are more volatile and some who are less volatile. Secretary Bessent is clearly the lower volatility, the VIX sub 30 type individual, which is what we have this morning. But again, going back to the first Trump administration, that's the way he likes to run it. The court fights amongst itself.
This is the problem, though, Julian. You've touched on it. That's what we have this morning. What do we have tomorrow? You've got a constructive view that goes beyond just 5 minutes. What does the rest of the year bring?
The rest of the year brings progress on the initiatives that have been brought forth. Look, from our point of view, if you think about a timeline, what you're going to get on May 7th from the Fed is a We told you we weren't budging. We're waiting to see more data. We have every indication that we don't need to move on interest rates now. So by that virtue, you've actually got to put some tariff points on the board between now and May 7th, more likely. And, it would seem reasonable to expect you'll start to hear better news.
I think this is an important exercise. You've got to try and get your head through summer. Let's get to the end of the summer and look out 12 months. What does that world look like?
We actually have to project that far out, Jonathan. I mean, investing is only a one-week thing now. No, look, the bottom line here is all of this has been a disruption to the way America does business. No question about that. And what you're hearing from companies now as earnings season gets into full swing is how they're trying to deal with it. But the bottom line is after they're dealing with it, the last 2 years of really being incredibly diligent and responsible about guarding and maintaining margins at the corporate America level means there is going to be an ability to make the transition. And so from our point of view, if you're thinking about the markets, the fact that consensus is looking for 9% earnings growth this year, down from 14, our view is you're still going to get 5, actually means that, the implication is A, there won't be a recession, which is our base case, but B, for equity markets, that's fine. That's his quote-unquote transition period.
What would make you change your mind and think the U.S. could tip into a recession?
The data would have to start rolling over severely. And look, we do think the data is going to moderate. But again, it goes back to this idea that what we have seen post-pandemic is a different world pre-pandemic. So the sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data. If that is no longer the case and we switch back to a pre-pandemic relationship, which we don't see, and that's why everyone is so much on pins and needles, particularly for the May 2nd employment report and then the weekly jobless data, that's a different set of circumstances. We just don't see that right now.
We're already seeing the data be distorted, though, flattered by some pull forward. We saw that in retail sales, particularly auto purchases, which I find amazing. You're worried about the economy, so you go out and buy a car. America, that's where we are. I want to understand what the rest of the summer brings. Once you pull forward activity, are we going to hit some air pockets in the next few months?
I think there will be, and if you go back to that last inflation report, which was softer than expected, is that a lot of the distortion was by a decline in price in used cars because people were buying new cars in front of the tariffs. So I think, again, this is one of these things in this higher volatility environment, we're living with the data being distorted. But if the overall trend remains intact, our assumption is we're going to be able to get through this without a recession.
So let's pick up the pieces. We've done a lot of damage, not just at the index level, but beneath the index, we've seen some real damage to some big tech names, some high flyers of the last several years. As you look at picking up the pieces, what do you like this morning?
We actually are of the view, and this is typical in when bear markets end, is that the things that got sold off the hardest, which in this case were the bull market leaders of the prior 2 years, are going to resume the mantle. Call it Mag 7, call it whatever you want, but the fact is that part of the U.S. markets, a large part of the U.S. markets' outperformance has been driven by technology. And for us, that is a story that has further to run.
Alphabet earnings 24 hours away. Julian, it's good to see you, sir, as always. Julian Emanuel of Evercore. Kid Jukes of SocGen writing, less Fed independence equals a weaker dollar. Even if we assume the president can't or won't fire the Fed chair, the makeup of the FOMC can change over time. Kit joins us now for more. Kit, welcome to the programme, sir. Do those words do enough to repair the damage done?
They do enough to stop the move we've had and calm things down. It looked stretched. But no, I think that the heart of the issue is that the rest of the world is dramatically overinvested in US assets and probably now realizes that they need to lighten up.
Kit, we've seen that rebalancing. It started. And to your point, the dollar long that's built up goes beyond just a couple of years. It's been built up over the space of more than a decade. Kit, how much rebalancing do you expect to see in the years to come?
How long's a piece of string, I guess. I mean, it's still the world's strongest economy, biggest economy. You know, they still do great things. So I don't think it'll all get reversed. I do sort of sit and ponder the 1980s when the dollar went straight up on the back of President Reagan's policies, and it gave it all up without the US losing its exceptionalism. So I, it could go down in the long run further than I think.
Kit, the Treasury Secretary recently said to me last week that the U.S. still has a strong dollar policy. Do their policies actually match that?
Well, yes. Well, okay. The dollar is strong. The U.S. has been running fiscal policies that are consistent with a strong currency, not a weaker one. But I don't see how the current policies are consistent with the dollar not losing some of its exceptional strength.
Exceptional strength will be lost, but you still think that the U.S. is the reserve currency?
Yeah, look, we still don't have a candidate or an alternative. You know, we've done gold, silver, the pound, and the dollar in the last 500 years.
Which is why a lot of people are going to stick with the US dollar. Kit, there are questions, though, about the current account deficit that's currently being run and how you attract that foreign capital. You're either going to do that through the FX channel, through a weaker currency, or you need much higher rates. Is it one or the other or both for you? And how do you think that plays out in the coming months?
I think it's going to be both over time, but I think that part of the challenge is if domestic capital leaves, for example, the world's biggest net investor abroad, Germany, has work to do at home, so they'll attract capital back. Then the US needs to save more at the margin as well. They can't go on running such big current account deficits, can't necessarily run such accommodative fiscal policy, and so I think we'll see a change in the States as well.
The most interesting chart for me, Kit, is over in Europe, and it's the euro versus China. Euro CNY, I think over the last several months has been fascinating, Kit, because as we've talked about on this programme, the biggest threat to price stability in Europe at the moment might be Chinese exports. Based on that chart, it could become a bigger problem in the months to come, Kit. What kind of relationship are you anticipating between the two trading blocs in the next year or so? What does it mean for this currency pair? And what ultimately does it mean for interest rates of the ECB?
I think it's going to be a difficult relationship at the margin anyway, just because China needs to find other places to export to, and Europe is going to be very wary of them dumping in any form into the European market. The challenge that we have at a foreign exchange level is that the yuan, the Chinese currency, really doesn't move very much. So it's static. So if the euro goes up against the dollar, it's going to go up against the yuan.
Kit, you said that... No, continue.
Sorry, and I was going to say, so the result of that is that we're getting a very strong euro against the yuan, which is going to deflate Europe at a time when that's not really what they want to do. And it leans against the fiscal expansion. And it limits how strong the euro can stay and get.
You said that the Europeans are going to be weary of the Chinese dumping on their market. Kit, do you think it's enough for the Europeans to put up their own tariff walls when it comes to China?
No, I don't think. I think Europe is very aggressively against formal tariffs. So, but I do think that once you've started kind of challenging free trade, that the whole thing is a more fragile edifice, and so it'll splinter a bit because we just get all these knock-on effects.
Quick final question for you, Kit. Euro dollar 114 at the moment. We all remember the days pre-negative rates back in 2014 when they were implemented that summer. We remember how stubborn the euro was, stubborn euro strength. What are we going back to? What kind of world, Kit? Are we going back to the pre-negative rate era of say 120, 130, 140? How do you think about that?
I can't see how, in real terms, that the euro can justify the levels of sort of certainly the 130, 140 levels. I think they're gone, frankly. I think we'll see 120 again. I think that's the bit I can manage in my head. But the European economy needs to develop much stronger underlying growth to get above that, for Locke to stay above that.
Kit, appreciate your input. As always, sir, thank you. Kit Jukes there of SocGen. Ives of Wedbush raising its price target to $350, writing Musk recommitting as CEO and leaving its Doge role is the biggest and best possible news investors could have heard. Tesla got back its biggest asset, Musk. Dan Ives joins us now for more. Dan, good morning. Good to see you.
Great to be here.
Okay, so you're saying this is a recommitment. Other people would look at this and say, well, he's still going to be there 2 days a week, and that's a problem.
I mean, I view this was an off-ramp. I mean, however you want to sort of label it, 1 to 2 days, I think this is the beginning of the end. For him at Doge, with Trump White House, because that was a different Musk on the conference call. That was a different Musk than we've seen actually over the years. He addressed it head on, read the room, and we've talked about it. It was a fork in the road, a moment of truth.
Sure.
He took advantage of it, and I believe now it's a new chapter, and he leaves a dark chapter in the past.
Let's unpack the perceived problem of the last few months that you called a dark chapter. Some people believe, many in fact, that the president and Elon Musk relationship has damaged the brand. In the mind of liberals, I want to be very clear about that point, and that's hurt the stock. Do you acknowledge that is what's happened over the past few months?
We've talked about it. I mean, it's the brand damage is real. It's been a dark cloud on Tesla's stock. We talk about anywhere from 10 to 20% because Tesla became a political symbol.
Why would that change if Elon Musk is still there 2 days a week?
Again, and I don't believe again, the 1 2 days a week, however you want to phrase it, my view is, and we've talked about it on the show, this is the off-ramp to be like, okay, 1 2 days a week and I'm gone. I'm not saying that you're not going to see him at times with Trump, but we believe this is his taking a massive step back, recommitting to Tesla. And look, this was a different Musk on the conference call. This was not the normal Musk. This was one reading the room, aware of everything going on from a brand perspective. And I believe it's going to start a new chapter. Well, the brand damage is still going to be there. But I believe at least it will be contained. He doesn't double down. And this was an important time that I think would define the future of Tesla if Musk actually doubled down and do it.
But how does he fix the brand damage now? To Jonathan's point, 1 to 2 weeks in the White House, he's also still the self-proclaimed first buddy. He's still going to be out there advocating for the president.
I think that's going to be significantly diminished. I mean, I'd be surprised if we sit here 1, 2, 3 months and that's still happening. Even on social media, I mean, he's still going to, say what he wants, but I think even some of that will be diminished. Look, I don't know if it's the board, if it's some of his confidants, but the reality is for Tesla, look, that's why this was a code red.
Is this a moment, though, for Tesla to realize that they actually need to brand themselves as Tesla, not as synonymous with Elon Musk?
I think that ship sailed. Because I think the reality is Musk is Tesla, Tesla is Musk. And so much of that has been a positive, despite maybe some criticism. The last 3 months, the reason it's been a dark chapter, not just because of the quarter deliveries, but the brand damage and what ultimately Tesla became a political symbol. And I think it's a recognition that needs to end.
Where in the world do they need to do the most work to bring customers back?
Well, I think China is the hearts and lungs of the growth story. I mean, BYD has obviously been very strong, NIO and others. And I think China is where you really need to start to turn this around. The brand damage in Europe, I think a lot of that might be permanent. And we've talked about potentially 20%. US, maybe 10% brand damage. And my view is just that's still going to be there. But you had to contain it. You have to start in terms of autonomous robotics, and this was a moment.
So show me the growth. Where does it come from, and how soon does it come?
Well, I believe a huge part of the valuation is going to be autonomous and robotics. I mean, my view, unsupervised FSD will start in Austin in June. When you look out over the coming years, I believe autonomous and robotics will be 90% of the valuation of the story over the coming years.
You spend a lot of time with the product. How good is it right now, full self-driving?
I mean, I think we're probably, let's call it 75% 75% there to where you need to be.
And how much progress have we made? So we're at 75 to 80 now. Where were we, say, 12 months ago, 3 months ago?
I think we were probably, if I go back maybe a year ago, so we were probably 60%, 65. Now, look, technically, you got to get to 99.999 to get there. But I believe they're making huge traction. And I think when we get to unsupervised FSD in Austin, that's a huge step to where the story needs to get to. And my whole point is, if this was an Intel, a Boeing, okay, so it's a disaster. It doesn't even matter in terms of, but for Tesla, it's my view, along with NVIDIA, two best disruptive technology companies in the world, that's what was so frustrating, why we were so loud, because you can't burn the house down now on this. You need to actually focus on the future. And I think that was a different Musk on the conference call last night.
When do we get to the point where we see Elon Musk's realization of Americans really won't go out and be buying cars anymore?
Look, I think that's still much more of a longer term view. I mean, I think
like a decade?
Look, I think that's something that you're going to have to go past to 2030. And I'm not a believer in that. I mean, I'm a believer autonomous is going to be a huge piece. Robotics is a huge piece. But that's much more, I think when you look longer term. But the reality now, it's about turning it around. It's about containing the brand damage. And it's about Musk. Leaders lead. This is the time to lead. And I think Musk took, for him, a huge step forward last night.
But it's not just Doge he's involved in. Neuralink, XAI. He is spread very thin. So why do you think all that attention is going to come rushing back to Tesla?
And that's who Musk is always going to be. But it's about the political damage that he did, because ultimately it became a political symbol for Trump administration, for Doge, and that can't happen. And I think I truly believe he underestimated the life of its own that this was ultimately going to become. And I think over the last few weeks there was a recognition, like, look, this cannot sustain going forward.
Are you overestimating the leadership it currently has in this sector? So this is the question that comes from a Bloomberg subscriber. Allow me to read it to you. BYD have introduced cars with double the range of Tesla and a 5-minute recharge. Tesla has the same car as 7 years ago, no innovation in their range and recharge. They're also ran in China. What would you say back to that?
I'd say let's talk in 6 months when we actually start to have, from an autonomous perspective, in terms of new vehicles that I believe are ultimately going to be out there, refreshes, and Musk and Tesla, how many times have been counted out? I mean, I can tell you in the last decade, or I could probably count on both hands.
I remember how many times BYD were counted out as well.
I'm more I'm not negative on BYD. My view is just when you look at the opportunity for Tesla, it is going to be really about autonomous and the robotics future. And I think for Musk last night, this will be a moment in time, historically. He had a choice. He made the right choice, in my opinion. And I think now we start a new chapter. Still a lot of wood to chop ahead. Challenges.
But BYD has something Tesla doesn't, which is easy access to the batteries. Yes. And China has 85% of the lithium. They have the processing to make these batteries and the raw materials. How challenging is that path forward for Tesla and other American EV makers?
But also it goes back to Musk in terms of Beijing and in terms of everything we've seen with Giga in Shanghai. I mean, the point is, like, Tesla is cemented in China. It's not like they're just a U.S. car manufacturer trying to get into China. That's why, from a raw material, from production, from a vertically integrated perspective. But when you talk about the raw materials, and we've said it, like that comes down when we talk about tariffs and talk about everything where's the materials coming from? They're not coming from New Jersey. They're coming from China. And I think that's also why, like, a lot of things happen in the White House. Walls caving in, and you could talk fairy tale, reality. And that's why also Musk is anti-tariffs, speaks some of the issues.
He got all the bad things to be the first buddy, but not the good things.
He literally got all the bad things, like all the bad things, in a horror show, none of the good. And that's why we're here where we are.
It's certainly not the conversation we had with you back in November, December time.
It's a lot different than that Cinderella story that turned into basically a Nightmare on Elm Street. But now we take a new chapter.
Dan, we'll see if it's another fairy tale. It's good to see you. Dan Ives of Wedbush.
Here at the International International Monetary Fund. It is a very different series of meetings. There aren't the same kinds of banners outside. It's a more subdued kind of feeling, and yet there are people collecting in Washington, D.C. for the first time since President Trump was inaugurated from all around the world, including the president of the Bundesbank, Joachim Nagel, who joins us now. I'm so glad to see you, and I want to start with this question of how different are these IMF meetings?
I guess this year, this meeting is a very special one. I think the world economy is in a very delicate situation, and I will use this time here to learn a little bit more what we can do to make it better, to make the economy running, have a better understanding what's going on, and there are really a lot of uncertainties.
One of the uncertainties is what's coming from the United States in particular when it comes to tariffs and how much that not only is a ramification for the U.S. economy, but also the global economy. How are you thinking about tariffs and how much they could depress growth, say, in Germany?
I said a couple of months ago, when it comes to tariffs, I was of the opinion that this will trigger a lot of problems. And now we see how the problems evolved over the last couple of weeks and months. And so we have to have a better understanding how we can find, let me say, a kind of a compromise, a kind of a level playing field that brings us closer together, because tariffs are not a good policy. This is for sure.
If they stay, is there a sense that it gives you more room to cut rates?
I think, first of all, I guess we have to take into account as central bankers also tariffs. What does that mean for Europe? I guess when we're talking about monetary policy in the Euro system, we are on a good path. I guess we can come close to price stability over the course of this year, and this is good news. But there's a lot of uncertainty, and so we said last week, because of that, we have to be very cautious. We have to wait what might come, how this uncertainty might evolve over the next week. So we have this meeting-to-meeting approach, and this, I guess, is the best way to conduct monetary policy.
Since the beginning of last year, since a peak rate of 4.5% at the ECB, you've cut rates 7 times, a deposit rate of 2.25%. Is that neutral?
I will not speculate about neutral. I guess only in hindsight we really know where neutral maybe was or maybe is. So I guess I have to look what the numbers, the figures are telling me, and there I see a lot of, let me say, good news when it comes to the inflation story. When we talk about economic growth, there's a lot of more uncertainty because tariffs are not good for economic growth. So the latest news that we got from the IMF here, we know that this is for Europe not good news. We are in a stagnating situation. So stagnation is the picture for this year, maybe recession for my country, for Germany. I cannot exclude a slight, let me say, recession this year. So this is what we have to work on, and monetary policy can only give us a good indication when it comes to a good direction, when it comes to stable prices.
The threat of tariffs has had an unexpected effect in markets of actually weakening the dollar pretty substantially and strengthening the euro, which on the margins could actually be a disinflationary force, especially if you're importing goods from overseas. That would lead to lower effective prices in euros. Does that give you some breathing room to actually cut rates in response to potential weakness if that reduces some of the inflationary pressure?
I guess it's much too early to really come to the final conclusion. What does this tariff scenario mean for both sides of the Atlantic? It seems to be, at least for the moment, that the price of that tariff decision has to be paid in the United States and not in Europe. It seems to be that prices might go up much more in the United States compared to the European Union. When it comes to economic growth, I think the picture is pretty much the same. It's also a drag on the economic growth here in the United States, also in Europe. But I will not speculate about monetary policy and what we will do next in our next meeting.
How much are you watching what China is doing in terms of any trade barriers from the U.S. causing them to export more of their production, say, to Germany, I mean, potentially lower prices with respect to an abundance of exports to the country?
I think China is an important player here. This is for sure. I guess it's not only for us, the Europeans, let me say, a very uncomfortable situation. I guess also for China. And yes, there might be a scenario that they are looking for new markets, additional markets. Europe was already being a market for Chinese products, but now maybe they can maybe use Europe more compared to the past as an additional market. But as I alluded to already, I think it's a lot of speculation. What does that mean, this tariff discussion? And it's too early to really assess what is the detail in really any aspect. It's much too early.
Just to add to the confusion, if you really are looking for any kind of compass and want to just change everything, Germany has been known for the zero debt break and this idea of not raising the deficit at any capacity. That has changed. We've been talking extensively about spending not only for defense, but also for a whole host of different investments. Does that create more inflationary pressure? Does that just improve the growth picture? How does that sort of influence some of your modeling?
It is important to say that the role of Germany does not change or that didn't change, because the stability anchor of Germany is still there. So as I said, I think we are living in a very complicated world. So it was necessary from a German perspective to do more regarding defense spending. It was also clear that we have to do much more when it comes to overcoming our infrastructure issues. So I guess this fiscal package is an important message to the world that Germany is doing its homework, and we will improve over time. The economy will do much better over the next years. And for me, as a central banker, this is at the end good news.
Well, but is it inflationary?
As far as I can oversee the current situation, it will not be inflationary, because we are coming out of a situation, stagnation this year, maybe a kind of a recession. So it's not inflationary over the next course of the years. It's helpful to the economy, means more economic growth, and this is good news.
One thing that's happened over the past couple of weeks in particular has been this fear of the United States losing its position as the currency of the world, as well as Treasuries having this special status. And one thing that we've seen in the flows is a lot of money going into German boots as sort of the new haven. And we're hearing a lot about diversification away from the United States into German assets. Do you welcome that? Do you think that would be positive?
Well, I think that it is not good news that there's a lot of, let me say, doubt regarding the safe haven of U.S. treasuries. I think this is not good news. And you're absolutely right. Some of that money went to German bonds. But all in all, we need the U.S. Treasury market as a good, stable market that gives a lot of, let me say, certainty. And we should overcome this turbulent situation, and we should give back U.S. Treasury this safe haven status, because it is not helpful to all of us if there are some doubts, uncertainty around U.S. Here about the U.S. Treasury market.
It wouldn't necessarily provide a support, the same kind of privilege of spending, I don't want to say recklessly, but with abundance in Germany, if Germany were to have that safe haven status?
I think Germany, and I alluded to that, is the stability anchor of Europe in Europe. German bonds is a perfect example for this, and this will not go away, but we need a good U.S. Treasury market. This is so important for the financial markets worldwide.
Speaking of which, you're going to be meeting with Jerome Powell, the Fed chair, at these meetings this week. What are you going to ask him?
I think Jerome Powell, he's a great guy. I really admire him, what he did over his career in central banking, and so we would talk about the current situation, yes. So
the current situation is potentially some sort of threat to central bank independence. That was taken off the table to some degree when President Trump yesterday, in response to reporters, said that he has no intention of firing Fed Chair Jay Powell, and that this was media speculation that was run amok, not necessarily any real indication that he was planning to remove him before his term was up early next year. How concerned are you about threats to central bank independence?
So what is important to me is that independence of central banks. This is the DNA of central banking, of good central banking. So we shouldn't, let me say, question to a certain extent that this is maybe something that we could see in danger. So independence of central bank is of utmost importance. And Jay Powell, he's a great central banker. He did a marvelous, good job. And I guess this is also seen here in the United States.
Do you worry about some sort of financial instability if that continues to be called into question?
I will not speculate here, but in a scenario that you just mentioned, I cannot exclude such a scenario that there is then maybe a lot of turbulence coming to the markets if this is in question. And we should avoid that. That shouldn't come as a realistic scenario. We should avoid that. This is of such a danger for the world economy. And so I really hope that there's enough understanding how dangerous this could be.
There's a question about what Europe can do to insulate itself and to draw itself closer, and that maybe some of the finance ministers and central banking chiefs can form something of a closer union to try to fortify themselves away from that type of volatility. Have you seen material steps toward that, to try to establish that type of stability in the continent?
Yeah, absolutely. I think Europe has, I guess, now a better understanding that we have to do our homework, becoming more resilient. We have to implement all what we discussed over the years. I just allude to the capital market union, banking union, maybe a little bit more fiscal integration. So Europe has to stand together in these complicated times. But on top of that, also these meetings here, the IMF meeting, the World Bank meeting, these 2-3 days are so important to all of us to work on international cooperation, multilateral. So the multilateralism of our work is so important in these days. So I will use these days here in Washington, D.C. to get a better understanding, to convince the partners here that cooperation is key in these days.
In the United States, there seems to be a move away from financial debt or incurring more debt, and there's this concern about the fiscal deficit in a pretty significant way. There is a goal to try to retrench some of the spending over the past few years. In Europe, it seems like there is a move in the opposite direction. We talked about that with respect to Germany, that there is a greater degree of willingness to spend. Do you think that that is appropriate throughout the entirety of the continent, given the fact that there is this desire to try to rebuild and regenerate a whole host of industries?
Let me disagree a little bit here, because I do not see that there is a momentum that we are going away from fiscal discipline. We have still a good understanding in Europe that we are currently in this complicated situation. So we have to do much more compared to defense spending compared to the past. But if that period is history, then we have to come back to fiscal discipline, and this is understood in Europe, and we will go back to that fiscal discipline.
Going forward, do you ever see a time when you could see zero rates again from the ECB, or even negative?
Well, as I said, I will not speculate here. I think we do what we have to do in our next meeting, and this is our mandate. This is our huge responsibility, and we did, I guess, pretty well over the past 3 years, and I'm very optimistic when it comes to price stability. That mission will be accomplished over the course of this year.
So do you think that you are going to get back down to 2% over the course of this year?
Absolutely, yeah.
Okay, and you don't think that necessarily there has to be any material change whatsoever to policy to get there?
No, there's no autopilot. I think we are decent central bankers, so we will assess the data, and then we will find maybe the right decisions.
Joachim Nagel, thank you so much for being with us. Joachim Nagel, the president of the Bundesbank.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.